I want to start out with here with pork as far as this goes. I want to kind of tell a little story about why we're at these incredibly high prices and why we're going to remain up here in the big picture going into summer here. Pork production numbers are down a little bit here from the past couple of years. There's nothing major about this chart, but however, pork production is not the driver of price. We take pork production, take out what we sell to other countries, what we export, and then comes with pork that's left in the U.S. here. And as you can tell, just this amount by itself, we're now at almost 10-year lows for the amount of pork that's left in the U.S. It gets even better because you divide that by the people in the U.S. to find a per capita supply. And as population continues to grow, per capita numbers look even tighter. Per capita basis, you've got back to 93 on this chart. It's actually back to 20-year lows in the big picture here on per capita supply. So this is what drives price in all the meats. Meats are based on per capita supply. So I want to point out, well, we've got a pretty darn tight supply based on per capita numbers, which is what drives price. Now, I don't want to get too much into these type of charts here, but we want to make one point here. Supply, we all know these type of demand-looking slides from maybe an Econ 101 class, but let's make this pretty simple. At the bottom here, supply. In this case, we call it per capita supply or per capita consumption. If supply goes up, well, prices are going down, and here's price on the left-hand side. However, let's see what this 2010 number looks way up here, tight supply and incredibly high price. This would imply, and if we had normal demand right now, we would have an average annual price, in this case $82. That actually would imply summer futures, which are the tightest supply of the entire year, up to this $90 range. So we want to make the point that right now, this market is probably trading around an average annual price right around this 74, 75 range, which gives us these numbers up to this mid-80s, low and mid-80s for these summer contracts. So in terms of this hog picture, this is an incredibly bullish, tight supply-driven market, which is why we suddenly had that dramatic past 3 weeks after the hogs and pigs report really changed the picture here. So in terms of hogs, we just want to make the point that there is a reason why we're up here in the 80s, and maybe we move to the mid-80s here, lasting through most of the summer here. Over on the cattle side, just a quick chart showing, look at the small bar here placed for this placements number. This is what we learned on Friday. Instead of producers getting very bullish last month based on that lower corn as well as sharply higher cash cattle price, these guys did not get too bullish. Cattle feeders did not put a whole bunch of cattle into feedlots. So right now, there's not a rising supply of cattle coming out of the feedlots here. We will note that seasonally, yes, we are on a slightly higher numbers in terms of the next few weeks, but at this point, we don't have any big bearish story based on big feedlot placements coming and hitting for that late summer, early fall time frame. So in terms of pricing right now on the cattle side, here's what the futures are saying. They're going to say we are going to have a normal slide in the summer, which happens all the time, but these are not putting any sharply bearish numbers in here. We still think that in the big picture, this is a kind of a wonderland story for these prices to be up here at this time of year. We're saying 88 to 90 for some cash cattle lows, which means June and August futures right around that 90 range for the future side. So 90 is our downside target for June and August futures right now.